For more, we're joined by Dr. Azar Jammine from Econometrics. Great to have you with us. Will the hammer fall or not?
I think the general consensus is that the hammer won't fall, but I do still believe that there will be a warning that the hammer could fall in the future if we don't do what we have promised to do in terms of fiscal discipline, in terms of fixing up the state-owned enterprises, and in terms of improving our economic growth materially. And all three of those require fairly unpopular measures in many instances.
And how relieved should we be? How serious would it have been if there still could be a downgrade?
I think on the face of it, it would seem very serious because, as you said in your preamble, if Moody's followed the course of action that S&P did, we would then be obliged to fall out of the World Government Bond Index. We only form 0.44% of that index, but the sale of 0.44% of that World Government Bond Index basically translates into a sale of over 100 billion rands worth of South African bonds.
Wow.
And the rand would fall sharply, and that would cause, well, the mining companies would welcome that, but on the whole it would be bad for South Africa because it would increase inflation and put an end to any hopes of interest rate cuts.
And would that apply to the sovereign rating, the one we call the South African rating, which is actually linked to foreign debt, and the rand debt? Which one is more serious? Because we've been talking about those two categories.
It's actually the rand debt that is more serious in terms of dropping out of the World Government Bond Index, because the largest proportion of our debt is held in rands and not in foreign currencies. Foreign currencies are a fairly small proportion.
And this makes it easy for global investors. They can go to this board, this bond index, and pick South Africa. If we're off there, does it become a whole lot harder for them to invest? Are they not allowed to invest? There's a whole lot of controversy around the rules around that. I think
it's about all of those three things. It is harder to invest, but that doesn't stop them investing in South African bonds. At the moment, until this past week, there has been such a high level of risk appetite internationally that some of these investors are only too keen to buy South African bonds, even if they're junk, because of the high rate of interest available on them compared with the very low rates of interest available on bonds in advanced economies.
So I'm glad you've picked up on this, because when the first downgrade happened, it was the end of the world.
Correct.
But actually the rand was okay and we were okay. The next wave of downgrades, it was the end of the world, but actually it wasn't. Why should we take this one seriously, given that track record last year?
Well, to some extent you're quite right. We can take this a little less seriously than we did previously, and that is because the global economic environment until this past week has been very, very positive. However, there are warning signs such as the potential trade war that might take place between the United States and China that could disrupt the whole global economic environment, and then suddenly international investors become very risk averse, and then they don't want to have anything to do with risky assets such as rand assets, and they climb back into dollars, and then you would see a very big effect from this.
So we need to talk about the trade war, but first what you're basically saying is when things are good, when there's so much money slushing around, people basically ignore the credit rating agencies, which is good for us.
They have been doing so, and it's a contrast with what happened immediately after Nhlanhla was fired at the end of 2015, when people were terrified and highly risk averse, and they didn't want to know anything about South Africa. We weren't even downgraded then. There was the prospect then that we would be downgraded, and that was enough to scare off investors.
And what can we do to stay the concerns of Moody's and the other rating agencies for a very long time now?
There are basically three prerequisites. The first is to ensure that we don't overspend relative to government revenue, so that we don't have to borrow too much more, so that the public debt to GDP ratio, which is the litmus test of the potential solvency or insolvency of the debt, because remember, ratings really are nothing more than a measure of whether any buyer of these bonds is going to get his money back or not. And if we have our debt continuing to rise, follow an upward trajectory, then we will be downgraded further. Secondly, we have to watch state-owned enterprises and ensure that they are not so badly managed that they have to get government to bail them out using its own debt. And thirdly, we have to ensure that our economy grows faster so that tax revenues improve and so that we can not depend so much on borrowing to finance our expenditure.
And isn't it so lucky for President Cyril Ramaphosa that the economy grew faster than expected last year?
It was very lucky that he basically ascended the throne, if I can call it that, at a time when world economic growth is picking up. Our exports have been doing better. Because the world economy has been doing well, international investors have had a lot of risk appetite and have been buying rands, and the rand has strengthened, which has meant lower inflation, which has meant higher disposable income growth and a faster economy. Yes, it has been fortunate.
All right, so it's all wonderful, and hopefully we'll avoid the downgrade today. But you're talking about this huge risk, this trade war. Is it a trade war? Because the US moved first on Chinese goods, and China, I see, has returned, putting tariffs on $3 billion or so worth of US goods. Yes,
$3 billion in the broader scheme of things is not much. Even the $50 billion that, or $60 billion that Trump used is not enormous. But people are watching this space very, very closely and seeing how idiotic Trump might become in this regard or not.
What does a full-scale trade war look like?
A full-scale trade war means that everyone around the world starts paying more for goods and services that they import. And so it obliges them to try and produce more domestically, but in instances where they can't do so very easily, it increases the cost of domestic production as well. So you end up having much higher inflation, and the average man in the street can afford to spend less than he did previously. So it's bad for economic growth.
And how serious for South Africa if the ante continues to be upped and upped and up between the US and China?
I think it is serious, because to the extent that it can be negative for the Chinese economy, that impacts back to South Africa in terms of the demand for many of our commodities that we export to China.
Our exports rely on Chinese economic growth, basically.
Correct.
The markets seem a little bit calm. Is that kind of the wait and see how bad this gets?
It is a wait and see. It's very much the same way as with the Moody's downgrade. The market is quite calm because people believe that these politicians can't be that stupid that they go ahead with it. But we saw in December 2015, that's what the market said about no, there's no way that Zuma will fire in Nhlanhlanene.
And that happened. And even in the UK, Brexit and a whole lot of things. Yeah. All right, fascinating as always. Thank you very much, Azar Jammine from Econometrics. And let's stay with